A company is considering investing in a 2-year project. Machine setup cost will be 125,000 payable immediately. Working capital of 4,000 is required at the beginning of the contract and will be released at the end. Given a cost of capital of 10%, what is the minimum acceptable contract price to the nearest $1,000 to be received at the end of the contract? So very good question. First of all, you have to understand the question. So in this question, what they are asking is, if you want to proceed with this contract, minimum how much you should charge from the customer. So customer will make you the payment in another 2 years time only. So for you to proceed with this contract, minimum you should have 0 NPV. If it is a negative NPV, you will reject it. So minimum you should have 0 NPV. So what we have to find out, at least to get a 0 NPV, minimum how much I should charge from the customer. So let's do the calculation. You should have a 0 NPV. That's the worst case scenario. Okay. So what are the cash outflows in year 0? So cash flows, there is a setup cost which is 125,000 into discounting factor is equal to your present value. So discounting factor for year 0 always it is 1. So here 125,000. And apart from that, there is a working capital that you have to pump in beginning of the project, which is 4,000. That one also year 0, 4,000. And end of 2 years, what you can do, you can recover the working capital that you have invested. Here the discounting factor under 10%, 2 years, how much you are getting? 0.826. So here 4,000 into 0.826, how much you are getting? 0.826, it's 3304. 3304. So what you have to understand is, for you to get the 0 NPV, how much present value you should get. So let's do the calculation and see. Minus 125,000 minus 4,000 plus 3304. So for you to get the 0 NPV, minimum you should get a positive present value of 125,696. So if you get this positive present value, then your NP will be 0, because the addition of these three present values, you are getting negative 125,696. So negative 125,696, in order to you to get a 0 NPV, you should have positive 125,696. So to get this positive 125,696, if your discounting factor is 0.826, because you are going to get the cash after 2 years from the customer, how much cash flow you should get from the customer after 2 years? So let's do a reverse calculation. 125,696 divided by 0.826 will give you the answer. 125,696 divided by 0.826. How much you are getting? 152,174. 152,174. So minimum you should get 152,174 from your customer in order to proceed with this investment. Then only your NP will become 0. So in this question, your answer should be what? They are asking for the nearest $1,000. So your answer should be C. Which of the following statement is correct? Tax allowable depreciation is a relevant cash flow when evaluating borrowing to buy compared to leasing as the financing option. So you will have tax allowable depreciation only if you purchase the asset or you buy the asset. If you lease the asset, you will not have any depreciation, so you will not have any tax allowable depreciation as well. So that statement is a wrong statement. Asset replacement decision require relevant cash flows to be discounted by the after-tax cost of debt. We can't say it is after-tax cost of debt, it can be cost of capital. So that's a wrong statement. If capital is ration, divisible investment projects can be ranked by the profitability index when determining the optimum investment schedule. So you know what is this capital is ration means. Let's take an example. There are two projects, project A and project B. Project A requires an investment of 100,000. Project B requires an investment of 200,000. Both the projects will give you a positive NPV. We'll assume like that. Okay. So for you to proceed with both the projects, how much you need in total? You need 300,000. This is what you need. But sometimes what will happen, you will not have this 300,000 to invest. You will have only 100,000. You will have only 100,000. Now here you can see the capital is limited. Even though you need 300,000 to proceed with the investment, you have only 100,000. The capital is not enough for you to proceed with all the positive NPV generating projects. So if the capital is limited, you should be able to understand or identify what is the best for the companies. So if the projects are divisible, how you can understand what's the best for the company? What's the meaning of this divisible? You can split the project into pieces. So if you are depositing money in the bank, if you want to deposit 200,000, even though if you have only 50,000, still you can go and deposit 50,000. That means that particular investment can be divided. But if you take a machine, there is a machine which has a value of 200,000. If you want to proceed with that investment, you have to invest 200,000. You can't just give 100,000 and you can't say give me half of the asset and I am going to take the half of the asset and I am going to proceed with the investment. You can't tell like that. That is indivisible projects. So if a project is divisible, how you can understand what's the best project is, you have to proceed with the profitability index. If the project is non-divisible, you have to go for a trial and error technique. So this statement seems to be a correct statement. If the capital is limited or ration, if the projects are divisible, how to identify the best project, you can go with the profitability index. If it is indivisible, trial and error technique. Next one, D. Government restriction on bank lending are associated with the soft capital rationing. So you know, capital rationing, there is something called hard capital rationing, there is something called soft capital rationing. What is this hard capital rationing is? Outside company parties, if they restrict the funds, like lending institutes, banks, if they tell no, we can't give the money that you want. So it is hard capital rationing, outside factors. If the capital is limited from inside the company, it is internal, or we'll call it as soft capital rationing. So here they are talking about government restriction on bank lending and soft capital rationing, which is not connecting. So that's a wrong statement. So for this particular question, your answer should be what? It should be C. A company has 31st December as its accounting year end. On 1st January 2005, a new machine costing 2 million is purchased. The company expects to sell the machine on 31st December 2006 for 350,000. That means they are expecting to use the asset only for 2 years, 2005-2006. The rate of corporation tax for the company is 30%. Tax allowable depreciation is obtained 25% on reducing balance basis, and balancing allowance is available on disposal of the asset. The company makes sufficient profit to obtain relief for the tax allowable depreciation as soon as they arise. If the company's cost of capital is 15%, what is the present value of tax allowable depreciation? So they are asking you to calculate the present value. So which element will affect the present value? You have to understand the tax saving. So how to calculate the tax saving? You know, tax saving is equals your depreciation into the tax rate or the tax percentage. So let's do the calculation. 2000 is the value of the asset, 25% reducing balance, which is 500. So this is the depreciation of the year one. So you know, depreciation into the tax percentage, you will get the tax saving, which is 150. This is the tax saving, which is 150. Then here you are getting 1500. And for the second year, there is no depreciation because you are selling the asset. In the year of disposal, you have to calculate either balancing charge or balancing allowance. So here in this question, you are going to sell the asset for 350,000. That means your asset value is going to get reduced by 1150. So you will have a balancing allowance. So here for that one, 30% means how much is that? 345. So this is the tax saving that you are getting for the year one, and this is the tax saving that you are getting for the year two. And realization period also same. It will, this 150 will be year one, 345 will be year two, because they are telling the company makes sufficient profit to obtain tax relief for tax allowable depreciation as soon as they arise. So it will be realized in the same year. So we have to calculate the present value now. To calculate the present value, you have to multiply from the discounting factor. So 15% discounting factor for the year one, it's 0.870. For the year 2, it is 0.756. So let's calculate the present values. 150 into 0.870 you are getting an answer of 130.5. Here 345 into 0.756, you are getting a value of 260.82. 260.82. So what's the total present value that you are getting? 130.5, 260.82. You are getting an answer of 391.32. 391.32. That means 391,320. So they are asking the answer for the nearest 1000. So according to this, your answer should be what? A, which is 391,000. An investment project has a cost of 12,000 payable at the start of the first year of operation. The possible future cash flows arising from the investment project have the following present values and associated probabilities. What is the expected value of the net present value of the investment project? Very good question, actually, joint probability question, but I would say highly unlikely you will get this type of question in your exam for the MCQ, because this question will consume lots of time, but for your knowledge purpose, for the time being, we'll do the calculation. So I'll teach you how to do the joint probability calculation. First of all, what you have to do is understand what are the possible outcomes that you can get. What are the possible scenarios are there? So what are the possible scenarios in this question that you will have? If you get 16,000 first year, second year you can get 20,000. If you get 16,000 first year, second year you can get minus 2,000. If you get 12,000 first year, second year you can get positive 20,000. So likewise, you have to understand all possible scenarios for this particular question. So let's understand all the scenarios first of all. I'll write here present values of year 1 and present values of year 2. So present value, first year 16,000, second year 20,000. This is one scenario. First year 16,000, second year minus 2,000. This is another possible scenario. First year 12,000 and 20,000 and 2,000. So first year 12,000, second year it can be 20,000, first year 12,000, second year negative 2,000. And final one, first year negative 4,000 versus second year's other cash flows. Negative 4,000 and here plus 20,000. Here negative 4,000 and here negative 2,000. So in this question, you can end up with 6 possible scenarios. So next what you have to do is, you have to calculate under each scenario, how much is the present value that you will get. So if you get the scenario number 1 as your output, how much is the total present value that you will get? It is 36,000. If you end up with scenario number 2, how much is the total present value that you will get? 14,000. If you end up with scenario number 3, what's the total present value that you will get? 32,000. If you end up with scenario number 4, what's the total present value that you will get? 10,000. If you end up with scenario number 5, what's the total present value? 16,000. Scenario number 6, total present value is negative 6,000. So you could get these 6 possible scenarios. Okay. So next what you have to do is, you have to calculate something called joint probabilities. So let's calculate the joint probabilities for this question. What's the chance of getting that 16,000? It is 15%, 0.15. 0.15. What's the chance of getting this 12,000? It is 60% or 0.6. 0.6. What's the chance of getting negative 4,000? It's 0.25. 0.25. So let's see the probabilities of year 2 also. 20,000 0.75, negative 2,000 0.25. 0.75, 0.25. 0.75, 0.25. 0.75, 0.25. So next what you have to calculate is, you have to calculate something called joint probability. So you know how to calculate the joint probability. First probability into the second probability. So 0.15 into 0.75, how much you are getting there? 0.1125. So what's the meaning of this 0.1125? Actually, the chance or the probability of getting this 36,000 present value, there is a probability of 11.25%. And let's do the next one, 0.15 into 0.25. Here how much you are getting? 0.0375. 0375. So what's the meaning of this 0.0375? The chance of getting this 14,000, the probability of getting this 14,000 is 3.75%. So next one, 0.6 into 0.75. How much is that? 0.45. So likewise, you have to calculate the joint probabilities for everything. 0.6 into 0.25. How much you are getting? Here 0.15. And next one, 0.25 into 0.75. You are getting a value of 0.1875. And finally, 0.25 into 0.25, you are getting a value of how much? 0.0625. 0625. So next what you have to do is you have to multiply the total present values from the joint probabilities. So let's do the multiplication there. 36,000 into 0.1125, it's 4,050. 14,000 into 0.0375, 525. 32,000 into 0.45, 14,400. Here 1,500. 16,000 into 0.1875, it's 3,000. Minus 6,000 into 0.0625. So how much is that? Minus 375. So what's the total amount that you are getting? 4,050 plus 525 plus 14,400 plus 1,500 plus 3,000 minus 375. So you are getting here 23,100. Your investment amount is how much? 12,000. Investment amount is 12,000. So here you are getting a NPV of how much? Expected NPV. It is 11,100. But what you have to understand, you will never get this 11,100. You will never get. You will get either this 36,000 minus 12,000, 14,000 minus 12,000, 32,000 minus 12,000, 10,000 minus 12,000, 16,000 minus 12,000, 6,000 minus 12,000. Those NPVs only you will get. Out of these 6 possible scenarios, only one scenario you will get. You will never get this 11,100 in short term. So this is just an average value. So keep that in your mind. That's a additional learning for you. So however, for this question, your answer should be what? It should be C, because it's 11,100. A company has a money cost of capital of 21% per annum. The inflation is currently estimated at 8% per annum. What is the real cost of capital? So using the Fisher's formula, you can find out the real cost of capital. 1 plus I means money cost of capital or inflated cost of capital or nominal cost of capital, any name you can use, is equals 1 plus R into 1 plus H. So here 1 plus money cost of capital, they have given 21%. I will write it as 0.21. 1 plus R into 1 plus inflation rate, they have given 8%. So I'll write it as 0.08. So your 1 plus R value should be how much? 1.21 divided by 1.08. So 1 plus R value is equals how much you are getting here? 1.21. 1.08, you are getting 1.12. 1.12 minus 1 is equals R. So R is equal to 0.12. So 0.12, if you want to convert into a percentage, multiply by 100, you are getting a value of 12%. So your real cost of capital should be how much? 12%. For this question, your answer should be B. I have done a comprehensive revision for ACCA Financial Management FM or F9 syllabus for a very reasonable price. You can purchase this revision through the link available in the description. In this revision program, I have covered 120 plus MCQ type questions and 6 constructed questions. For each question, I have given you detailed answers and I have provided some additional learning as well. So I hope this revision program will be useful for you in order to pass your exam. If you like my video, don't forget to like it, share it, and make sure to subscribe my channel.